Hey everybody, welcome back to another Midas Letter Daily. I'm here with my good friend and co-host, Mr. Edward Milewski. Special Head, how are you today?
I'm fine, beautiful weather.
It's a spectacular day. Sun is shining,
nice.
It's above 20 degrees.
Nice to be down here in southern Ontario.
And markets are crumbling. Yes, folks, here we are in the great deflation of 2022, quickly heading towards a recession. We might soon be calling this a market crash. We might call it the great recession
the
of
moves
2022.
are so big. Like, this is really, it's acting like there's nothing there. They're thin. They're acting like thin markets, and we're talking, trillions of dollars.
It's unbelievable.
And it's moving around like crazy.
So today we're going to be talking to Eric Roth, the CEO of Capella Minerals, and Capella is mining, or rather exploring, building resources in copper, gold, cobalt, mostly in the Scandinavia region, but also in Canada. He's a long-time successful miner. In fact, you'll hear during our conversation that some of the big wins he's had. So typically, if Eric Roth is involved, it becomes a mine and gets sold on to some bigger company. That's my own experience. I've known the guy for...
That's his MO.
That's his MO.
He gets the job done.
Exactly. So also this week, we're going to be talking to Matt Fernley, managing editor of Battery Materials Review. Battery Materials Review, sorry. Matt is based in London. Matt has been an analyst in the battery metal space for a long time, and so he's now out on his own providing this fantastic service. He has some great insights into the battery metal space that a lot of people do not really have. So that's interesting. Also in the battery metal space, we're going to talk to Steve Vasiludis, who is the CEO and founder of a private company that is doing a direct lithium extraction technology, but not on brines, on spodumene. Not only that.
Holy smokes.
That's not all.
I never thought that was going to happen.
Yeah, but also, so their process is using CO2 to capture the lithium out of the concentrate that they make and eliminate the highly toxic, environmentally hazardous acids. So it's very funny that, and talking to him, that he has a similar approach as the DLE techs do in the brine side, but this is one that is being applied to, this is the only one I know of that's being applied to by spodumene and hard rock sources, but he also makes mention of clay. So that's today's show. If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Let's go to some audience questions, shall we, Ed?
Sure. Well, there's a good one for you.
Where do I get my loud shirts from? I get my loud shirts almost entirely from Etro.
Yeah.
But there's a smattering.
Is that an Etro?
This is Paul Smith and occasionally Eaton.
Yeah. Etro, they're cool.
Yeah. Gail Connor, are you selling in May and going away? Gail, here May is, and I basically have sold everything that can be packed into a truck and sold. Why? Because I am developing a giant farm project and it is consuming all my capital. So I'm flat the market right now. The only stuff I have left in the market is stuff I can't sell because it's
not worth it
underwater. Yeah, it would cost me money to sell it.
You think we're ever going to see a day where all this paper is just going to become worth zero because it's...
Well, yeah, but it's always temporary because there's always a consolidation because the life force always persists and finds a way. That's all you got to really remember.
The life force persists and finds a way.
That's what we're talking
Well
here.
stated.
Well, thank you. Fox Stocks wants to know, is Elon Musk's tweet the best and most simple investing strategy? And he says, since I've been asked a lot, buy stock in several companies that make products and services that you believe in. Only sell if you think their products and services are trending worse. Don't panic when the market does. This will serve you well in the long term. Well, that is investment advice that'll work for somebody who's already a billionaire, no doubt. The problem with most of us, and I'm assuming that that's most of you out there too, is that we don't really have $1 billion to...
We'd like to make $1 billion.
Yeah, well, no, I would not like to make $1 billion because I know that making big sums of money is dangerous for my health. I've experienced this firsthand on multiple occasions in my 20s and 30s and 40s.
Because you start thinking you're smart?
No, it's because you start thinking you're invincible.
Yeah.
So smart is definitely a subset of invincible.
It's funny, eh?
Health-wise,
you want to get a person to change their personality, start giving them money.
Well,
It's
exactly.
It's
Money will
mind-boggling.
turn anybody into an asshole. I am living proof. And Elon Musk is living proof too. That's a great strategy if you're an asshole billionaire. But, for most of us, the key to a thing when you're deploying capital for an investment is most of us have a timeline. It's like, well, I'm going to put this money into the market because I've got some money put away and I don't really need it and I can let it grow. But they don't anticipate the event in their lives that says, oh no, you need that money back now. And the universe doesn't care that, but it hasn't gone up in price yet. In fact, it's
You've
cheaper.
locked it up.
Exactly. It doesn't care. So for people in that boat, I think you need to look at your investing strategy and choose investments that match your risk profile, i.e. how much can you afford to lose that money and how long can you afford to have that money in the market before you have to take it out. So his advice is not the most simple and it's certainly not the best. It serves large capital pools. For myself, I'm a small cap speculator.
You know what's really important, I think, if you're talking about investing or and making money, you gotta systematically save money. As you receive money throughout your life, you should keep shoveling a little bit over here and leave it alone, and then it'll do some magic over time.
I didn't learn that until I was 50 years old.
I still haven't learned it.
I've always been an all-in kind of guy. Oh yes, well that's.
I don't even tell me.
So Mr. Slakini wants to know, Graphene Manufacturing Group has one of the most disruptive battery technologies out there right now, but how will they scale that technology in the next 5 to 10 years? Mr. Slakini, they will employ the industrial clout of larger corporate partners, such as the relationship they have with Robert Bosch, the German industrial conglomerate who is currently building their commercial site. That's how you scale technology, is you bring in partners and you give up a little bit of control, and that's what they're doing. Daryl Penner wants to know, what is the best attribute that makes you successful in the markets industry? I would say that is persistence and the ability to communicate.
Make money.
And
if you can make money and keep it.
It pays. I mean, everybody's got their own. I mean, one of the most successful market players I know is he's both a lawyer and an accountant. Those are two great attributes to have.
Yeah.
But you can only use those attributes in a certain way. My talent is almost exclusively in the communications aspect and the schmoozing space. And I can only use those talents in certain ways.
Okay.
So there are a lot of attributes that can make one successful if you use them in the right way. But the ability to be disciplined, the ability to be conservative, the ability to be educated are probably the most important attributes. And the ability to study history, I would say, is a very important attribute.
History repeats itself. Or it certainly, if it doesn't rhyme, it certainly repeats it or something,
Anthony Palmer wants to know, why do big tech stocks love buybacks? Well, Anthony, among the reasons that big tech stocks like buybacks, I know what Ed's going to say.
Yeah, and I just heard someone say it again. You see, when an insider buys a stolen stock, he puts his own money in. That they say that's important. What they're doing basically is they're taking the house money, and they're buying stock to provide liquidity for all the options that all the insiders have. There's an element of that.
Yes. But the bottom line is, when a company buys stock using debt at sub 1%, it's better than earnings because it reduces the amount of shares out there, so the value per share goes up in terms of their earnings.
Sure.
And so it ultimately, as Ed said, makes the value of the stock increase. That's why big tech stocks love buybacks.
And the insiders own lots of the stock, so they love it. Hey, this is
fun. So if you can buy performance as opposed to earn performance then that's easier.
But
and that's
sooner
why
or later,
the
chickens come home to roost. I saw a chicken on the steps of your house there.
Yes.
Is that chicken coming home to roost?
That chicken's home. It never left. Anthony, we did that one. 101 wants to know how to look for ways to make money in markets even when markets are on a downwards trajectory. How to look for ways? Well, the way to look for, the the good thing to do is just to monitor the outflow of information from companies and the world and try to identify value discrepancies when the market hasn't reacted to news. For example, if you'd have, when the war in the Ukraine started, oil was what, $70?
80-ish. I think
Yeah.
it started 80, maybe 85, but it had been on an upward trend.
Yeah. So the war started and markets tanked, but oil took off because the war took a whole bunch of Russian oil off the market. So that would have been a case where, had you looked at the news that Ukraine is about to be embroiled in war with Russia, that would result in a reduction in Russian oil as a result of sanctions, then you could have bought oil and made a fortune. So that's one of the ways that you can look for ways to make money in markets. But there are a ton of ways, and that's just one strategy. Wally Voss wants to know, I watched your interviews with Lithium Chile and Summit Nanotech. Seems the CEO is not in favor of Saskatchewan petroleum brines. But as this also has huge potential, might it be possible to interview somebody from that side of the industry? Thanks. Well, Wally, the reason that Amanda was not in favor of petroleum brines was because they are typically very low grade. The lowest grade brines in the industry, 70 to 90 parts per million on average. And she clearly stated during the interview that her technology needed a minimum grade concentration of 200 parts per million. So that's very simply why she's not in favor of petroleum brines, is because they are not appropriate for her company's technology. Now, I do have a guest coming on whose DLE technology is specifically designed in part to extract low-grade petroleum brines like those in Canada economically and very efficiently. And that guest will be on my show in a couple of weeks, so you will hear from them. They're out there. We'll hear that story. Don't you worry. VJ wants to know, could I ask for you guys to potentially touch on potential sectors or asset classes that could thrive under the current very hawkish high inflation environment, or what stance fund managers may be taking?
Well, head for the hills.
Yeah, the general market consensus among fund managers is to become defensive. And what do they mean by defensive? It's time to get out of stocks that are increasing in value because of a healthy economy. So this is the time when people start to buy things like Walmart and Procter and Gamble and the companies that, make the staples that everybody has to keep buying when everything else is down. And because those companies are going to be the beneficiaries of fresh interest, because there's no point in investing in the tech stocks, the mining stocks, or any of these other stocks.
A stock that's been on a tear is Clorox. For some reason, Clorox is magical.
Yeah.
Going back to basics, aren't we, James?
There you go.
Back to basics, everyone.
So some potential sectors, mining and battery metals especially, are going to continue to do well despite the deflationary phase that we're in right now, I believe. Though you've seen slight deflationary pressure on the biggest stocks in the space, SQM and Albemarle, Livent and others. The juniors, I think, are one of the best places to be participating, especially in the DLE space. And I say that as a conflicted shareholder in one junior company. Olympia Vietri wants to know, will Bitcoin be able to hold this critical downside level?
Well,
that's
it's starting to look
in that it's a speculative asset class that is extremely volatile and not at all contingent on any fundamental. Olympia, I have to say that it's a 50-50 shot in either direction. The one thing that's true is the longer the deflationary phase of this market persists, the less capital there will be to enter the speculative side of the Bitcoin trade. So no, I don't think it's going to hold 30,000. I think it's going lower. Victor White wants to know, what do you think we will take away from this week's CPI data point? 8.2%, so up 1.1% from the last month. So clearly inflation is still rising despite the increase in interest rates. But I refer you to 1980 when interest rates went almost 20%, or did they go over 20%? It took a lot of interest rate rises before inflation was brought under control. So look for that to happen again. Follow us on Twitter, Instagram, LinkedIn, and Facebook. Make sure you never miss a show by subscribing to our YouTube channel and clicking on the little notifications bell. If you're interested in getting monthly actionable investment ideas in the cannabis space to your inbox, subscribe to the newsletter at midasletter.com. Edward, let's start with a broad look at the markets here.
Wow, a lot of carnage.
Pull up, let's see here, watch list. Let's go to the main watch
The NASDAQ
list.
is firmly in bear market territory.
Yeah, so we're doing this recording here at Wednesday afternoon at about noon Eastern. And so all of our comments are relative to this time frame. And some of them are relevant to, it doesn't matter what day of the week it is, because they're profound truths.
Yeah.
They're always true. Okay, so right now today, so S&P's down 0.34, Dow's down 0.12, NASDAQ's down 0.11, almost 1.1 after a day of small recoveries yesterday. But backing out the chart, going to the year-to-date look here.
Yeah.
This, let's see, so from year-to-date, we are down, what does that say? Boy, I wish they'd make these numbers bigger on this thing, eh?
Yeah. Magnifying glass.
Down 16.84% on the S&P.
Yeah.
The Dow Jones, there's 2022. The Dow Jones is down 11.6% now, year to date. But NASDAQ is down 25%.
Yeah, 25.
So that is, that's a bear market move for sure. That's a bear market.
A lot of
move
those
for
companies that raised a lot of money in the IPOs were hot are never going to make any money.
Right.
And everybody knows it. It's crazy. Like some of the stuff that went on in the crypto world with certain types of coins, the stable lists, and I don't know.
Yes.
It just got out of hand.
Yeah.
And somebody's going to pay for it.
But the interesting thing, and this is what makes it clearly a deflationary general event, is all sectors are suffering. All sectors. Gold is down to 1852, down 11.
It's suffering one of the least.
Well, it's suffering one of the least. But if we go to the year-to-date look on gold,
Yeah.
what do we got here? Well, it's actually up 3% year-to-date. So you're right there, Ed. Yeah, it's not
just another pretty face.
Another pretty face. So, and one of the great lessons in gold's performance currently,
see, it looks like it's down, but it's up.
Relative to crypto, this is where you can see clearly that gold is a alternative monetary asset, whereas crypto is clearly just a speculative bubble. Here's the chart on crypto. So now crypto year to date.
Put up a year to date. We're right there at the
so
lowest.
Year to date is down 36%.
36%. That's whopping.
That's whopping.
Yes, sir.
That's a whopper. So
it takes two hands to handle a whopper.
So there you go. There's a speculative asset class for you because it is emulating very much and amplifying the trajectory of the major indices, which are all speculative in nature, whereas gold is a conservative asset, a reserve asset,
been around 5,000 years.
Whether you're a sovereign entity or just dude.
It always came back to gold.
Yeah, so gold is the standard against which all monetary instruments have been measured for, well, easily 2,000 years, but on and off for 5,000 years. And this is why, it's very easy to lose track of the importance of gold in this context. It stands alone, well, not alone, gold and silver stand alone as alternative monetary assets, which crypto, I'm sorry, it is demonstrating clearly, does not. And, the issue with Luna and Tether, so Luna was supposed to be algorithmically stabilized to the US dollar, but the creator of Luna had to sell.
You're saying there's a fly in the ointment?
Well, one fly in the ointment, the many weaknesses that are going to destroy the crypto assets that are not digital bank crypto assets.
So you really think that it looks more and more now when you start to see these charts and the way they're starting to point, there's no way these things can expand when the world's contracting.
Well, a deflationary, when all asset classes are deflating, and we're talking everything here, real estate, commodities, precious metals, industrial metals, tech stocks, bank stocks, everything.
Right. But gold.
Well, gold is
it's
year to date up on the year, but it has come down.
but it's still 1850.
It's
It's
down
1850.
5% from its high of this year.
Yeah. Well, yeah, but bear markets, you got to be down 20%.
Well, so this is the thing. Even people who are holding gold are going to put some of that into some cash, because when the whole market goes deflationary, the broad perception in the biggest capital pools is anything can happen. Anything can happen, and this is largely. Nassim Taleb wrote a book called The Black Swan. Where the unpredictable, the unknowable is out there, and money managers of substantial experience understand this. So when the market turns into a deflationary phase, there's no point in trying to rush in and buy any
rules.
dip. Well, there's
the rules.
Well, there's a
what
few
I say,
simple realities.
Right.
If you sell everything at the low, then
Right.
you've locked in the loss.
It's gonna happen.
If you
I know.
just wait it out, that's going to be painful because your portfolio is going to be very low priced.
When the Japanese bubble hit in the 80s, that it still has never gone back.
Right.
Some of these things are never going to come back.
Right. So the general rule of thumb is, unless you've used leverage to build your position in a market that turns deflationary, if you're leveraged, you've got to get out and get flat, because otherwise
you're gonna lose it all.
Yeah, but if you're in a
all.
cash position, many times it's best, and I'm saying this because I've panicked and sold when the market turns deflationary.
Right at the bottom?
Yeah, sold out everything at the
right?
bottom, which is where you don't want to be selling stuff, and then it wasn't the bottom even. It keeps
You're
going.
killing me.
But the bottom line is the better move would have been to just hang on, and they recover. Eventually, the recovery comes. In this situation, everybody's expecting that the Fed is going to blink. They're going to say we got too aggressive. They're going to start printing money again and reverse interest rates.
Yeah,
What do you think?
It looks. I'm looking for a bounce here, and I'm starting to fear that I don't think I'm going to get it. I think. Every day there's more evidence to suggest that things are out of control, and they've got to do something about it. And the way they do it is to tighten it all up. There's going to be a lot of pain here for a lot of people, but it's only money.
So in these times, it's also good to look for bargains in the commodities space, because the first thing to recover after the market turns reinflationary are commodities. And so here's Eric Roth to tell us about his copper, cobalt, gold, and silver properties. My next guest is Eric Roth. He's the CEO of Capella Minerals Ltd, trading on the TSX Venture under the symbol CMIL, and in the United States under the symbol CMILF. Eric, welcome.
Thanks, James, and thanks for the introduction, and also a big welcome to all your listeners as well, too.
I feel like I've been following in your shadow over the last decade, if not quite a bit more, because, let's just cut to the chase. You've got a history of wins in the mining space. So let's start with an overview of your career to date and some of the wins you've been involved with.
I'll just go quickly back through the whole history, but I guess I am originally a geologist out of Australia. But I guess most of the years since then, I've been working in Latin America and elsewhere with companies such as AngloGold and others. The two companies that are the most recent wins that you mentioned, and that's where we first met, was the Extori gold mines. That was a very high-grade gold-silver project that we had in Santa Cruz province in Argentina. And we had a sister company called Exeter Resources, which had the Caspici. It was a very big porphyry project in Chile. And as you know, in the interim, both of those companies have been subsequently bought out. So they're now in new homes. Then on the back of X-Story, I basically got involved with a company called, Mariana Resources. We essentially, we basically had the Hot Maden project in Turkey, which was a very high-grade gold and copper asset, and one of the highest-grade assets of recent time. And it was also acquired in 2017 by, in this case, by Sandstorm Gold. So as you say, we've had some really good success on the exploration front. I guess the key spot for us, the niche spot for us, if you like, in the business is identifying the high quality exploration projects, making the discoveries, bringing them through resource status, and then of course taking them through those early sort of first mining studies. And because we do focus generally on high grade deposits, once you start throwing some economics around these things, that obviously attracts a lot of interest. So as you say, we do have a few wins under the belt, and it's always nice to say that, well, we've had quite a few discoveries along the way. So I guess we can say that we, have a good sense for what needs to be done and, of course, how to do it. So I guess that's a pretty important box to tick for investors as well.
Right. Okay. So let's talk about Capella Minerals. What's going on there?
Basically, we have a good mixture of gold and copper assets. The focus at the moment for us in terms of the projects that we manage 100% are in Scandinavia. We do also have 2 high-grade gold joint ventures in Canada. Now, both of those joint ventures in Canada are in the hands of the joint venture partners. One is called Domain, which is in Yamana's hands as the majority partner. And the second one, of course, is Savant Lake, which is in Ontario. And that's a JV with Prospector Metals, which used to be known, your listeners might remember them as Ethos Gold. They just did a name change very recently. But the projects that we focus 100% on are the Scandinavian assets. And the focus really is we have 3 high-grade copper assets in Norway. These are what we call massive sulfide deposits. And again, it really follows that our business model of looking for high-grade assets. And in this case, in the case of the Norwegian assets, these were actually former mining districts. So the nice thing is that we know there were mines in the area. And in fact, those mines were in production literally for hundreds of years. They closed in the mid-1980s for 2 reasons, not because they run out of potential, simply because in the 80s, of course, copper prices dropped to about 60, 70 cents a pound. And of course, now we're sort of a north of $4 a pound environment, so completely different environment today. But of course, the other thing in Norway too was the discovery of oil. And I guess, oil spun off so much revenue that basically people just walked away from the mining industry, and it just went into hibernation for 40 years. So I guess on the Norwegian side, so we're very happy to have district scale projects around 3 former mining districts, one of which is called Hesjegruve, the other one Skjoli, and the other one Lokken. And just an aside too, so Lokken was actually the biggest massive sulfide deposit of its class, and I think people forget, how much copper did actually come out of Norway. I mean, it's it's just one of those forgotten things in modern history. So, and as I say, Lokken was a big deposit. It was about 24 million tons, 2.3% copper, 1.9% zinc, just to give you an idea of the grades. And the work that we've done in all these districts suggests very good cobalt concentrations as well. So I guess going forward, we'll be focused not just on the copper, the zinc, but we'll also be looking at cobalt and gold and silver and some of these other elements that really were never taken into account in the economics of these things. We also have a gold project in Sweden, and we have a gold and copper project in Finland. And I guess the Swedish one is still fairly early stage, so we're still in the process of doing that systematic sweep. We have gold-bearing boulders on surface. Essentially what we're doing is we're looking for the source of those boulders. And the project in Finland, we're very fortunate to have been able to pick up this ground. We picked it up in August. This was basically August last year from a company called Cullen Resources. We've earned into 70% of that ground. And it's in a part of the central Lapland greenstone belt where, especially the Canadian viewers will be quite familiar with that part of the world. There's a lot of good discoveries that have come out of there. You've got Rupert Resources, of course, at Ikari. You've got Orion Resources down the road. You've got the mid-tiers are quite active there. So you have Kinross, you have B2 Gold, you have Agnico Eagle. So we're very fortunate to have been able to acquire, a very nice 200 square kilometre land package in what is very prospective ground. So just in summary, I guess, so we're split between Canada and Scandinavia. Our primary focus is Scandinavia. And we have, I think, a really good mix of gold and copper, and of course thinking about those other metals that come along with the copper as well, such as the zinc, the cobalt, gold, and silver as well.
In the current deflationary environment catalyzed by Fed sort of retracement from rampant spending and zero interest rate policy, is the expectation that there will be more of a focus from the investor community on junior mining as opposed to, the tech sector that has been dominating the interest of investors globally for a decade now?
I guess we, as on the exploration side, we're always the eternal optimists, but I do think it would be nice to see some of that money coming back into, what I consider a really undervalued, an incredibly important part of our economies. I mean, it's, I look at the valuations of the tech stocks, or if I look at crypto or any of these things, personally, I just think they've just gone completely out of whack. And it's kind of nice to a certain extent to see a bit of a correction, if you like. But at the end of the day, I mean, I think, it'd be nice to see some of that money come back into the junior mining space. And at the end of the day, look, we are looking for commodities that the world actually needs. And we know that, particularly from a green energy perspective and, the energy transmission and energy storage, we need the copper for energy transmission. We need the copper, cobalt for all the electric cars that people want to have. So we do actually, I think we are, I don't want to use the word unloved, but we are a sector that really could see some, it would be nice to see some of that cash coming in from these overvalued sectors back into our sector, as a general comment, I think.
In Scandinavia, I'm curious as to, we're always used to hearing about the difficulties of negotiating with governments in undeveloped countries. What's it like to negotiate investment contracts with developed countries?
Well, that makes a big change because, as most geologists, usually end up in quite a few jurisdictions around the world. And to be honest, I've been actually quite impressed. I think the projects that we've pushed the furthest so far have been the Norwegian and the Finnish assets. And to be honest, we've had a lot of good support from both governments. And here, when I talk about governments, I talk about everything from federal to regional to local. If I look at Norway specifically, for example, we've had a lot of support from the local community. And in fact, that local support really helped us get into this latest project called Hesjegruve. People were so happy with the work we were doing at the nearby Skjolli project. They said, you guys have got to come and have a look at this. Hesjegruve was an advanced stage project that had been sitting there since basically the early 1980s. And it's a real joy. I think we've had a lot of good support. And the other thing, too, to keep in mind, too, is that a lot of the areas we operate in, because they were former mining districts, most people, they can see the old mines. They all had, a lot of people had grandfathers and family that worked in the mine. So it is actually part of the DNA. I think people forget how important mining was in Scandinavia for literally hundreds of years. And I think it's just, one of those things that people forgot. Just one of these sort of, asides. People don't realize that the copper on the Statue of Liberty in New York, for example, came from a Norwegian copper mine. Just to, they're just sort of anecdotes that you think, well, okay, but it's quite incredible to think that, these countries had mining for hundreds of years and there's still plenty of potential there. And we've had a lot of support for the projects that we've been working on.
Particularly in the case of the copper price performance, seeing it go above $5 was heartwarming, to say the least, as a long-term copper investor. But now, of course, it's in retreat, and that's part and parcel of the deflationary package that you get when the central banks collectively collaborate on reducing balance sheets while raising interest rates. But there's been a real deterioration in the quality of copper mines at the head grade level. And there's been a dearth of new mines brought on. So I'm curious as to at what point does the supply side increasing while the demand side deteriorates, at what point does that catalyze new mine development?
I'll start on grade to begin with, because obviously, if you look at most of the new mines that have come into production, let's say the last 50 years or so, there's been a very strong bias to the big low-grade porphyry copper deposits, right? Which, but as you mentioned, even those, the grades have been dwindling as we go. Some of the new mines are less than 0.5% copper, which is quite incredible when you think about it. It's they're huge volumes you've got to mine. at only 0.5% copper or even less. And, so they're huge capex. I mean, to build a mine like that, they're phenomenal. I mean, they're just huge operations. There's a big capex that goes into it, a lot of investment needed. And at the end of the day, you're still not home and hosed, in the sense of a lot of the porphyries have arsenic problems too, because they have other arsenic and other problem minerals associated with the copper, which you then need to deal with. And that specifically is why we focused on these relatively small, high-grade, massive sulfide deposits, James. And really the twofold side from our side is, one, they're high grade. So, and when we talk about high grade, we mean 2% copper or better. So we're not talking about, a lot of people will say, high grade is a different number. But from our side, 2% is what we're looking for as a minimum. The other thing, too, with these massive sulfide deposits is they're very clean deposits metallurgically. They're very simple to get the copper out. They generally never have any of these nasty elements in them, like arsenic and things like that, which, of course, you want to avoid if your final product is a concentrate, because, of course, all the stuff you don't want also gets concentrated into that. And then the other thing, too, because they're relatively compact operations, they're high grade, they're very rich, they're very compact operations, so they're relatively small. They've got a small development footprint, and a lot of them are underground operations. So there's almost no, there's very little on surface. So that's what we focus on, really, these high grade deposits with, good metallurgy and relatively small development footprints. And of course, a small development footprint also means relatively easy permitting. So that's really what the focus is. So we, from our side, we focus on grade, but also making sure that, the metallurgy looks okay and all of these things even before we start, because that's obviously very important. You've got to know what the final product looks like before you even start.
All right, Eric, we'll leave it there for now. That's a great introduction to the company. We'll come back and have you on again soon. And thanks for joining me today.
Thanks, James. Appreciate it. And look forward to seeing you again soon.
You bet. PDAC.
PDAC.
I'll see you there. Look, this thing has been a lot higher.
2000. Yeah, well, you see, look, like a lot of these things get rolled back. Now, how many shares are now in the thing?
151 million.
Oh, yeah. Yeah.
So anyways, this is a company that could, be a sleeper investment if you start to pick away at it now, build a position, because it's not going to go much lower than, where it is now. Anyways, so that's what's happening there.
And this is Canada and Scandinavia. Obviously there's going to be shortages. No matter what it is, there's only so much of it.
Yeah.
So it's just a matter of time, right? Are we reaching sort of a limit in the earth, you think?
Well, here's a concept.
Is that why the left wingers want to reduce the population?
Well, the interesting thing is the population is going to start reversing by the end of this century, regardless. In fact, there's 21 countries that are forecast now to have half the population they do now, including China, Italy, and Spain.
That's not good for stock markets.
Well,
I'm telling you.
The nature of this.
I'm telling you.
There's no doubt it's not good for stock market.
It's all about money. I mean, people going into an area.
Yeah.
You tap them all.
Well,
but if there's half to tap, you make half the money.
Well, we've reached a point where the ability of the market to go up or to create more wealth and have more wealthy people investing in the market is, I think that's what's been reached. I think we're at peak inflation in terms of monetary inflation. And this is what I think scares the Fed, is that if this doesn't work, if raising the rates and dialing back the balance sheet doesn't work, then the only thing that they can do, just as like a publicly traded company, when they've got so many shares out, they can't raise money, they have no choice but to consolidate the stock. And that is what happens when the hyperinflation of a currency is untenable, and they have to stop it, and they have to essentially roll it back. And everybody suffers when that happens. But that's the thing. In that moment...
Not if you're Bill Gates, you don't suffer.
Well, you don't suffer as much, but you suffer a loss. You suffer a loss in purchasing power. You suffer a loss in nominally.
You have to admit, these are fascinating times, James.
Yes.
Like, we are now witnessing... This is going to make 2008 look like chump change. That's what I think.
Well, it depends. I mean, again, it depends on where you what part in the market constellation do you occupy. In 2008, if you were all in on real estate, you got annihilated. But if you were diversified across real estate, financials, and gold, you didn't do too bad. You came back okay. And if you were all in tech stocks, if you went all in on tech stocks at the bottom, well,
You'd have made a fortune.
you're now a billionaire and a complete asshole to everybody.
Yeah. That's why people think I have money.
Well, but
'Cause
this
I'm
is
such
the
an
thing
asshole.
to recognize in the major deflationary episodes in the market since 1972. There's been like 35, 40%
This happens.
plus
This happens.
corrections, and they always end up in the markets going to a new record high.
I know. It's
So-
hard to believe, isn't it?
Yeah. So that's the main thing to keep in mind is
Yeah,
when
right,
it looks
right,
hopeless,
Right.
just
No.
remember this too shall pass, as some great sage once said, and that applies to markets.
No, I think the saying was "Et tu, Brute."
A2 Brute? Don't know it. What does that mean?
That was when Julius Caesar, when they killed Julius Caesar.
Ah.
And then the guy said, "And you too, Brutus?" Like you.
Oh, right. You're
It's
killing me too.
Shakespeare.
Yours-
Yeah. Not you, my friend.
Yeah. Well,
You know how I don't know much about this stuff either.
yeah.
Okay.
Our next guest knows a thing or two about battery metals. Here's Matt Fernley from Battery Materials Review. My next guest is Matt Fernley. He's the managing editor of Battery Materials Review at batterymaterialsreview.com. Matt, welcome.
Thanks very much. Great to be here.
Matt, it must be a great time to be the editor of a publication called Battery Materials Review, in that markets are crumbling, yet battery materials are still rising in price, and the companies that produce them and use them are also sort of enjoying a sweet spot currently. Give us an overview of what does Battery Materials Review really focus on and cover, and how do subscribers find it?
Well, I will say it's fun now. It's been a difficult time though over the last 2 to 3 years leading up to this, so I'll take any joy when I can. Basically, I am a equity analyst on the sell side and on the buy side, and I looked at the battery sector 2 to 3 years ago, and I couldn't find really anything on it that pulled everything together. So that's why I started Battery Materials Review. It's like a one-stop shop for everything you need to know on the battery sector, from the upstream into the midstream down to the downstream, what demand trends are looking like, what supply trends are looking like, what companies are doing what where, and what materials are in vogue at that moment and why they're in vogue. So really it's aimed as a sort of one-stop shop for people to learn about the battery materials sector, but also to find out about what the drivers are at any one time.
One of your more recent articles actually focuses on the burgeoning new battery production planned for North America by the likes of CATL and LG, among others.
Yeah.
So I'm sort of interested in focusing on that a bit, because it's like, are these guys going to build batteries for the incumbent auto manufacturers? Are they going to build batteries for the emerging breed of new electric vehicles? Or is it going to be all of the above? And is there no North American competitor who's going to sort of take issue with the fact that they're setting up such big production facilities on North American turf?
It's kind of all of the above. So obviously, I mean, if you look at the breakdown of electric vehicle sales sort of globally at the moment, it's dominated by China and Europe, and the US market is a relatively small market, which is obviously dominated by Tesla with over a 50% market share here. And if you look at the cell manufacturing, basically 100% or certainly over 90% of cell manufacturing in North America is carried out by Panasonic for Tesla. And what we're talking about here is a situation where all of the incumbent automakers, the OEMs like GM and Ford and the European automakers and Japanese automakers with North American businesses need to build out their EV supply chains, which involves building EV factories, and that involves building cell factories, and as importantly, building out the midstream and upstream supply assets for those operations. So at the moment, the major operator is Panasonic. They've been pretty staid in terms of their battery expansions over the last 2 to 3 years. And in fact, most of the Korean and Chinese producers have sort of leapfrogged them in terms of becoming the largest producers in the world. And in fact, that's what we see in North America. It's the outward-looking Korean manufacturers like LG Energy Solutions and Samsung SDI and SK Innovation, who are opening up operations into this market, have formed joint ventures with Ford and GM and other players in the market. But, I've said for a long time, North America has got all of the advantages in terms of its sort of raw material supply base. Canada in particular is in a great spot. Canada's got most of the key battery raw materials. It's got lithium, it's got cobalt, it's got manganese, we hope, it's got nickel, it's got graphite. And on top of that, it's got something which is really, really important to the battery industry at the moment, which is hydroelectric power. Cathode manufacturing, anode manufacturing can be quite a power intensive process. So having hydroelectric clean power has the potential to make the battery industry that much more environmentally friendly than it is at the moment, whereby you dig the stuff up in Australia, you ship it to China for processing using very dirty power, and then you sort of move it out elsewhere around the world for further processing. So, there's a huge opportunity for North America out of the EV story, and we're starting to see the groundwork being laid now. And it's very interesting to note that, the early movers on this were the Europeans, who were talking a very good story about integrating and backward integrating their supply chain. They've spent the last 3 years talking, and the North Americans have spent the last year or 2 years starting to take action. And they are now in a position, I think, to leapfrog Europe in terms of building out a viable EV supply chain going forward.
One of the most pressing issues on the ingredient side for EV batteries is obviously the divergent supply-demand lines in the lithium supply. And so, I guess it obviously is important that lithium is available to would-be battery manufacturers. But I'm curious as to what extent does the divergence in the futures market lithium price at roughly $85,000 per ton versus the actual contract delivered price to battery manufacturers today of, call it $20,000 to $30,000 per ton. How is that reconciled to the future price growth that the actual manufacturers are going to pay? That's the first part of my question. The second part is, isn't lithium shortage relative to demand going to catalyze alternative battery chemistries that don't involve lithium?
So just to start off with on the lithium prices, there's a real juxtaposition in the market between the spot price, which you said is around about $70 a kilogram now, and the contract price. Now, the lithium market is going through quite significant changes, and in many ways, what's happening in the lithium market is quite similar to what happened in the iron ore and coal markets during the China commodity super cycle 10 or 15 years ago. And that was a market that went from trading on annual contracts, sometimes multi-year contracts, to a quarterly and spot market. And it took probably 2 to 3 years before prices fully transitioned over from long-term contracts to shorter-term contracts. And that's effectively what's happening in the lithium market at the moment. So the brine producers out of Latin America, which is the traditional source of lithium, they are primarily using longer-term pricing and volume contracts, whereas the new boys on the block, the Australian hard rock producers, are using shorter term pricing contracts, but still longer term volume contracts. And those pricing contracts are slightly backward looking insofar as they look at the last quarter's price increases, but they're much more closely linked to the spot price than the annual price contracts and multi-year price contracts that you're seeing out of Latin America. Now, over the course of this quarter, some of the Latin American brine producers have moved more over to a quarterly pricing mechanism, but some of them have still locked into legacy contracts with cell producers in mostly Korea and Japan. And as a result, the realized prices you're seeing from some of the Latin American brine producers are closer to sort of $20 to $30 a kilogram rather than the current spot price, which is around $70 a kilogram. So that's the situation on prices. And over time, you'll see that the longer term components of that will become a much smaller percentage of the industry. So I would expect the industry to converge towards spot prices or last quarter spot prices over time. And, you know, a lot of producers are particularly in Western Australia, who are starting up production now, are moving to, you know, a large percentage of their production or a reasonable percentage of their production directly exposed to the spot price. The second part of your question was on structural supply and demand, if I'm correct, and this is a really difficult one. You know, if we were in a bog standard commodities market and prices went up 10 times as they have done in the lithium space, we would be seeing demand destruction for certain. We would see demand destruction. In this market, we're not really seeing that to the same extent. And the reason that we're not really seeing that, in my view, is because electric vehicle sales are not directly driven by the consumer. They're driven by governments. So particularly in the EU, to some extent in China, EV sales are subsidized by national governments. And as a result of that, we're not sort of seeing the demand destruction that you would expect to see as the higher raw material prices filter through the supply chain. In some areas, we have seen third and fourth tier battery producers, cell producers, raise prices at the end of last year. That's filtered into EV producers. In fact, I've just written about that in this month's issue of Battery Materials Review, and we have seen, you know, 4 or 5 EV producers globally and 15 or 20 of them in China raising EV prices. But you see, the problem with EV prices is if you look at the median EV price, it's probably about 30,000 euros per vehicle, whereas the median price for internal combustion engine vehicles, I'm talking in Europe here, is about $15,000. So EV prices are not really in mass market at the moment. And as a result of that, there is less price elasticity there's less demand elasticity to price. Having said that, the other issue that we're dealing with in this industry is a huge shortage of supply. And, you know, we expect prices to remain at elevated levels going forward. And actually, at the beginning of this year, I actually introduced a second EV sales forecast, which is an unconstrained EV sales forecast. And I've taken down my EV sales forecast to deal with the material constraint, primarily lithium, but also graphite and some of the other battery raw materials. And, you know, by 2025, my constrained EV sales forecast is about 19 million units a year, and my unconstrained EV sales forecast is about 40 million units a year. So the auto manufacturers are actually going to be giving up around about 50% of the sales that they could have been doing because there's just so much of a supply constraint. And this sort of rounds out our views on the equities and on the producers, because there's so much of a supply constraint. It's going to be a real it's going to be a very, very tight market for 5, 6, 7 years with regards to sort of lithium supplies, but also other battery raw materials.
Have you seen any alternative battery chemistries that don't involve lithium that have a realistic chance of becoming a significant disruptor to that anytime soon?
Yeah, I mean, this is a question we get a lot. The answer to that is not really in electric vehicles. So the next technology that's supposedly around the corner, been around the corner for about 5 years, is solid state, which involves replacing the anode with solid lithium metal. Now, that's not so great because the shortage here is in lithium, and lithium metal is obviously very expensive. So I don't really see solid state becoming a big mover and shaker in the industry until probably the mid-2030s, maybe later than that. On the energy storage side, or on the stationary storage side, there are competing technologies. So things like vanadium redox flow batteries, chromium, zinc, iron flow batteries are different chemistries to lithium ion. And they could take off, in my view, and probably should, because they offer a slightly different offering to lithium ion. Lithium ion is what we call a very short duration product. It has once the energy bleeds out of the batteries, it lasts for about maybe 2 hours, 1.5 to 2 hours, whereas some of these long duration technologies that will last for 12, 18, 24 hours. And that's relevant if you're putting your batteries together with, for instance, a wind or a solar plant, because if I'm running a solar plant, I charge up my batteries during the day, and then they can basically discharge over the whole night and provide a steady state supply. So having a long duration battery in that situation is very, very much positive. So these other technologies are there, but they're just waiting for that sort of gigafactory moment, if you will, when somebody says, look, here's $1 billion, I'm going to build a gigawatt-sized factory, and we'll take that forward. But there are, a number of early stage companies that are looking to commercialize these techs. And in fact, vanadium redox flow batteries, VRFBs we call them, have actually been around since 2015. We're hopeful that some, if not all of these techs can take off. Going forward, I think that they won't totally replace lithium ion in ESS solutions, but it would be nice to see sort of like a hybrid solution where you can take some of the weight of demand off the lithium ion space and replace it with other materials.
Mm-hmm. Okay, great, Matt. We're going to leave it there for now because we're out of time. I really appreciate your contribution. Thanks for joining me today.
Pleasure. Thanks very much indeed.
So if you like that, go check out his website at batterymaterialsreview.com. He does have a subscriber track, but he also has a lot of fantastic free information. And the interesting thing that I learned going to his site is how to rate graphite companies against each other was one of the things I found really interesting on his site. My next guest now is a private company based in Australia who is developing direct lithium extraction, but not for brine, for spodumene and hard rock sources of lithium. My next guest is Stephen Vasiludis. He's the CEO and founder of Novalith Technologies, which is a private company from Australia. Steve, welcome.
Morning. Thank you very much for having me on.
You bet. It's a pleasure. Steve, let's dive right into it. Your technology is focused on extracting lithium from hard rock sources, correct?
Correct, yeah.
Can you give us just a quick overview of what the technology is and what it's for?
Our technology uses a novel approach to removing lithium from hard rock resources, and we're also doing some work into the soft rock, such as the clays. But in a nutshell, we use supercritical CO2 and water to directly extract and refine that lithium as a lithium carbonate. And at the back end of the process, we can also convert to lithium hydroxide if need be. But really what we're trying to do is negate the requirements for strong acids such as sulfuric acid, which is pretty much the go-to tried and true method.
Okay, so your process then inserts into the line and replaces the sort of sulfuric acid portion of it. But so do you start with essentially extracting the rock, crushing the rock, and then introducing it to your process?
Yeah. So the front end and the back end is very similar. So we still have to go from rock to a concentrate, from a concentrate being say an alpha spodumene to a beta spodumene. So you still have the calcination step up front. But then we pretty much step in from that point. And instead of having, say, the acid roasting, the impurity removal steps, you're converting from sulfate to either hydroxide or carbonate. We basically take all of those unit operations out and replace it with our LiCal process, which is a carbonic acid leach. And at the back end, we can still crystallize out or precipitate out that lithium carbonate in very much the same way.
So where are you at in the development of this? Are you pilot testing yet, or is it still in the lab?
Yep, so we're pilot testing at the moment. We've actually got a couple of reactors running and a couple of systems operating. We're trying to characterize as many of the different types of spodumene and other kind of soft and hard rock resources that we can at this stage. One of the great benefits of our technology is it's very, selective with regards to lithium. And because of that, the effective impurities is not nearly as significant in our process versus, the conventional using a much stronger acid. And we're just trying to quantify and really benchmark how broad the application of our technology could be.
So does it have applications for brine-based lithium?
At this stage, we don't think so. It'll probably be only your rock sources. Reason being with brines, there's a lot of water to process. There's a lot of cool new technologies in the DLE space coming to light. And at the moment, we're trying to solve the environmental issues and the cost issues around the spodumene hard rock resources, as well as your clays. Especially if you're looking at, say, your clays, you have a tremendous amount of rock to process with a relatively small amount of lithium. And if you're using the conventional process, your reagent costs are, very, very significant. Never mind for both the soft and the hard rocks, where you have to then produce all of this bulk, say, sulfuric acid and other reagents. And, from an environmental and cost point of view, having a large sulfuric acid plant to then kind of, feed the reagent to your refinery, if we can avoid that, I think, it would generally be better in the future. And you'd obviously save a ton of money. The cost of sulfuric acid is not cheap. Whereas if you're using, say, CO2, which we can either get from the calcination process and recover that CO2, which would have otherwise gone to waste, or from supporting industries. If we couple this to, say, SMR, turning some blue hydrogen, a lighter shade of green, and capture that CO2 and fix that CO2 in our process, that's really a win-win.
Is the grade of the lithium source relevant to the cost of production in your process?
From what we've seen, no. And it's because of that selectivity. So we're getting really good extraction and recovery rates from the ores that we've been testing. And again, because it's kind of relatively insensitive to the impurities, we're finding that we're still getting great recoveries at a higher and lower percent of lithium oxide.
So then how soon until this process would be available to all of the hard rock miners of lithium in the world?
Well, I'd love to say next year. So we're pushing very hard in our pilot stage at the moment, and we're doing a lot of, additional kind of R&D and pilot work. And we're looking to start the design for our commercial demonstration plant towards the back end of this year. So we're kind of really in kind of a data accumulation step at the moment, getting as much data across as many resources as we possibly can. And then off the back end of that, we'll be looking to build our first little commercial demo plant, which we expect, design commencing end of this year and looking to operate the year following. So probably 23, 24, that'll be in operation.
Apart from the input savings, which are apparent, are there CapEx differentials between the traditional process and your process?
Because it's such a simple process, again, a single step versus a two-step, so going from, say, sulfate to whatever you want. With us, it's carbonate directly from the rock. And because of that, there's a lot of unit operation savings. And less kit means less cost and also less space.
What is the model for you to roll out this technology? Is it like a technology as a service platform? Will you put it onto brine or rather hard rock operations that you have ownership in?
At this stage, it's pretty fluid. And once we've developed the technology, it's likely that we'll be a technology vendor. And so we'll have this, great piece of tech, validate a resource, particular resource owner, and then work in partnership with, say it's a greenfield site. We don't want to become an engineering design house or big EPC. We really want to kind of keep our core tech to ourselves and then help to distribute that as widely as possible. And so we'll probably provide that to the resource owner in partnership with a larger EPC, or work directly with the resource owner themselves if they have that capability to upgrade their plant.
It strikes me that clays are, they're the most problematic source rock for lithium. And so is the process different from spodumene relative to clays?
Well, the big change is we don't calcine up front. At least from the work we've done, there's no need to calcine. So you get a bit of a CO2 saving, so to speak, that side of things. But our process flow sheet's very, very similar for the clays and the spodumenes. And that's, again, another big benefit of our process because we're getting quite, actually great recoveries. We don't need to then put additional bits of kit on, and that's selectivity too. So we don't need to put additional bits of kit on to deal with, tremendous volumes of rock or tremendous volume of impurities that you then have to deal with. Given that, in clays, you're talking about 1,000 ppm, plus minus. Whereas your spodumenes are, as percent, anywhere between, say, raw spodumene 1 to 2%, and for your concentrates, high quality concentrates sitting at between 5 and 6. So massive difference in terms of the amount of lithium you have versus kind of the volume of impurities that you'd have to process and deal with.
Do you have a conceptual target average cost, all-in cost per ton of production?
So all the modeling we've been doing thus far, we're looking at sub $4,000 a ton for lithium carbonate. But again, this is still very, very early stage, so I have to put a big kind of disclaimer on that one. We need to do further work on this at a larger scale to kind of really validate those costs and also normalize those costs for the region. Putting a plant in, say, Canada or North America is going to have a very, very different cost base than putting a plant in, say, Western Australia, Europe, or China, given that the cost of utilities, reagents, whether CO2 has a value or not. So all of our cost modeling thus far has assumed we're purchasing in that CO2, as well as using a very dirty source of CO2, which we need to then scrub and pressurize up. Whereas we might find that, hey, we're actually getting carbon credits, in which case it becomes a more attractive proposition.
So what sort of opportunity would there be for investors who might be interested in participating in your success should the opportunity present itself?
Well, we have to fund our commercial demo plant. And so we're probably looking to open up a Series A towards the middle of the end of this year to get some cash in the door to help us actually build that plant. And so at that stage, we're putting out, we'll basically be opening the doors to investors. And if there's any interested investors, feel free to reach out and contact us either via the website, or I think I can probably just bug you for my personal detail.
That's novalith.com.au for those who are interested. Steve, how much has gone into the development of the technology? What sort of has been the historical trajectory of getting it to where it is today? Yeah,
so a quick history on the technology and where it originated. So it was developed by a really, really great professor called Dr. Brian Haynes at the University of Sydney, and this is several years ago. And then off the back of that, we acquired the IP outright from the university and then started kind of trying to commercialize it with all haste in August last year. And so we completed our seed funding rounds. We raised 2.5 million Australian dollars, led by the Clean Energy Finance Corporation in Australia and supported by the Grantham Foundation out of the US. And all of that money's pretty much gone into doing kind of scale-up work and the original test work performed at the university, and so operating at a couple hundred times scale relative to what they were doing. And also now building a number of these reactors in parallel. Given how quickly the lithium market, all that demand for lithium is increasing, we want to make sure that our technology is advanced enough to slip in and become a realistic kind of means of supply. If it takes us 10 years to get that technology, we're going to miss the boat. And so we're really pushing to get something, real and commercial within the next 2 to 3 years.
Well, Steve, sounds fascinating. I am going to be looking a lot more closely at it and probably participating in one round or another. I appreciate your time today, and thanks for joining me.
Great. Well, thank you so much for the time. Really enjoyed that.
You bet. Bye for now. Yep, that's a private company. They're raising money. If you want to get involved with this company or learn more, go to their website. And if you need an introduction to Mr. Veseludis, I'd be happy to accommodate. So there's our show for this week. Hope you enjoyed it. Don't forget to write. We love to hear from you. We'll see you next week. Thanks for watching.